Hello to you all. Hope you're doing well. So I've just had a conversation with John Bellamy from Waverton Investments. Waverton are one of the investment managers that we used, and I've asked him a series of questions about what's happening in markets at the moment and how things might pan out in the future, which I thought you might find of interest. So have a watch. If there's any questions from you for me or for John after watching it, please let me know. Look forward to speaking soon. Bye. How are investment markets behaving, given all that's been going on in the world? To what extent are the various markets that we mainly invest in, the UK, US, Asia, etc., to what extent have they recovered from the significant falls that we saw in sort of end of March, April time?
Well, they've recovered obviously sharply. There's been a V-shaped recovery, and we've referred to this at times as clients, advisors, investment management have kind of been given a get out of jail free card because if you didn't know what you were in, you might have got a nasty shock in March and April, but before you had time to really set about doing something about it, the markets have recovered. So there's no question they've recovered strongly. I can make an equally strong case for this is rational behavior from the markets or it's irrational behavior from the markets. I mean, the rational side of things is, cash rates are zero. There's nothing to do with your money. There's a huge amount of liquidity coming from central banks. And instead of rates being talked about as lower for longer, they're much lower for much longer. So, that would point to a higher value in equity markets. But then on the irrational side of things, we don't know what this recovery is going to look like economically. We don't know whether it's a V-shaped recovery. I've seen the V-shaped, W, L, and people are even talking about K now. So you've got an alphabetic spaghetti of possible recoveries there. So it is very hard to judge. So you shouldn't really be betting too much on either of those outcomes, I don't think. And in terms of what markets have recovered, there's been a massive differentiation as well. We've seen, the NASDAQ is up 33% year to date, whereas the UK market is down 20%. And that's not just because, the US is a more dynamic economy. It's all to do with the sectors, really. So if you look at the broader US, the S&P is probably up 20% or so year to date. Sorry, I'm getting a phone call, which I'll cut off there. The S&P is up 20%. As I said, the UK is down 20%, but it's the sectors within those markets.
Okay.
So the US has a lot more exposure to IT, which has done extremely well. And we have a lot more exposure to financials and energies, which haven't done well.
Okay.
So geographically, we're seeing some big differences. US top, UK near the bottom. Sectorally, within those, we're also seeing these big differences. IT at the top, and then retailers, financials, and miners at the bottom.
Okay.
So yeah, very, very broad differences to all of those.
Yeah, that's something that comes up actually in my conversations with clients from time to time. Is the US market so heavily reliant on these few companies, the Amazon, Facebook, Netflix, these Google. It's overwhelmingly dominated by those companies. I mean, to what extent is that a concern? And if so, is there anything that Waverton does to kind of manage it?
I don't want to appear as I'm sitting on the fence with everything, because I could answer that two ways as well. I mean, it is a concern, right? Whenever the market is being led up and the breadth is narrowing, i.e. fewer companies are going up and more are going down, which is what we're kind of seeing at the moment. That's always a concern. And those stocks that they're referred to as FANGs and Microsoft, if you throw Microsoft in, those 5 stocks now make up 25% of the S&P. The largest 5 stocks before the dot-com boom made up about 17% of the S&P then, and everybody was getting concerned about that. Wow. So that, yes, it's a concern, and it speaks to this sort of IT, non-IT argument, if you like. So the bit that takes the concern out of it from our point of view, because we're about equally weight, we're slightly underweight those stocks. So we're not taking a massive bet either way. The bit that gives us comfort is if you look at the earnings, the compound annual growth rates of the IT sector is about 7% per annum since going back to, 2012, around there, about 7% per annum. If you take that sector out of the S&P and look at the compound annual growth rate, it's -1. So there's a good reason those companies are going up. They're disruptive and they're growing.
Yeah.
Whereas the companies that they're disrupting and not growing are obviously the ones that maybe you should have the more concern about.
Okay. So is that perhaps where say someone has gone 100% passive and they're just tracking an index, is that makes that potentially more risky as a way of?
Well,
What
it's
was it? Hard to
potentially more
say.
risky in that you can't decide when the time has come that these things are getting a little bit too stretched. Now,
Yeah,
I wouldn't like to say whether it's a PE ratio of 30, 40, 50 or whatever, but at some point, we make decisions in our portfolio. So we're not particularly exposed to the financial sector at the moment.
mm,
There's a good reason for that, because with interest rates so low, banks have got there's no net interest margin there. It's very hard for them to make money.
okay,
They're being led by the government as to whether they can pay dividends or not. It's just not a particularly attractive sector. So we choose not to be there.
sure.
Passively, you can't make that choice.
Yeah,
If you're just buying an index,
yeah,
that's what you're getting. And I suppose the big decision you've got to make if you're buying passively is, well, you're going to buy the FTSE or you're going to buy the S&P, because the difference in returns are so huge.
yeah,
If you feel as a client that you can make those decisions rationally, then fine.
yeah,
But if you can't, I would suggest you look to an active manager to do that for you, because the difference in returns are stark.
yeah. It's night and day, isn't it? Yeah,
Yeah, exactly.
yeah. Okay, okay. And just coming back to the UK then, so the one thing that I seem to be asked quite often is about the furlough scheme and how that sort of propped everyone up over this period of lockdown, and necessarily so. But it's unwinding, and then I think it's beginning or end of October. I can't remember exactly when
Yeah,
it
October, I think,
finishes,
yeah.
and we'll really find out then whether the end of that scheme, we'll find out if people are being made redundant or they've got a job to go back to. I guess we don't know at this stage, do we?
Yeah.
How do you see that impacting things?
Well, that really is the $1 million question, and it speaks to what shape is the economic recovery going to take? Because as you say, there's a huge number of people that are sitting on furlough at the moment, and it's sad to say that probably a reasonable percentage of those they're unemployed. They just don't know it yet. They're not getting their job back. I've spoken to a number of people in our industry, sort of advisors that have staff furloughed. They're unlikely to go back because the technological advances we've seen has meant that we can work from home, we can work more efficiently, and less hands can do more work to some degree. So it is going to have an impact, and it's one of these things that we're saying is we don't understand the depth of that yet. We're probably going to get a good idea of it here first, and in terms of overall global markets, the UK into the furlough is not huge, but it obviously is the UK economy. It will also be a good pointer because Europe, I think Spain, France, Germany in particular have pushed out their furlough scheme, so they'll be getting them for longer, and I think the US a little bit longer as well. So it's going to give the world the first sort of indications as to what the damage will be.
Okay.
And then the read through from that is, we've just come out of a recession, but that's a government-induced recession. It's not a business cycle recession. But is the unemployment from the end of the furlough and such, is that then going to lead to a business cycle recession?
Sure.
And that's the concern it gives us. So I don't know what the impact will be, but it could be profound.
Yeah. Okay. Is that sort of a couple of questions around that then? So is that partly why you think partly explain why the UK stock market hasn't recovered to the same way that, say, the US has, for example?
Well, I think that the UK has a couple of overhangs. One is Brexit, but I think that the most important one for the differences in returns between the UK and the US, for example, is the concentration of cyclical sectors within the UK market. So there's sectors that are unloved. So we've got a lot of miners in there, and we've got a lot of financials, energy companies, that are just unloved, and we have virtually no exposure to IT, and that's really what's been driving it. So
Okay.
it really is more of a case of that. Sterling strengthened a bit recently, which goes against our index a little bit, but I think it's more to do with the sector exposure than anything else.
Okay, that makes more sense. So, as an investment manager, then, how do we overcome that? Just simple diversification, right?
Yeah. So we are global. We've got, of our equity exposure, we've only got about 10% in the UK, which we've actually been adding to because the valuation metrics are getting quite stark now. The difference between the two. So So you think, well, there might be a bit of opportunity to start putting a little bit in early, but it's still only 10% of our equity exposure. And the US is probably upward of 43, 44% now.
Yeah.
So that's where we choose, coming back to the active passive. You know, we're actively choosing to put our money where we feel the engine of global growth is going to be. And we don't see that as being in the UK at this stage.
Yeah, sure. Is there a point though where it becomes, I mean, the typical measure that most people will follow would be, say, what the FTSE 100 is. That's what the news reports most days. Is there a point where that just becomes so, if a point reached where that becomes so low that you think, well, actually it's worth putting more in now? Or
Yeah,
is it that kind of valuation metrics that you think?
Yeah, it's not it's two things in tandem. Is what's the level, what's the price of whatever it is you're going to buy, and what's changed to make that now buyable, if you like. And I've been talking to some clients about this because we are sort of generally underweight risk assets at the moment, because we're cautious on the outlook. And they, well, what's going to make us go back in? And you could take this for the FTSE or anything for that matter. It'd be one of two things probably. One, more clarity on the economic outlook. You know, what are we buying into? And we don't know that. And whilst we don't really know it, we're not prepared to risk too much of our clients' money. So that would be one thing. And the second thing might be just be a lower entry point. So if things get to the point where they're ridiculously cheap, then you obviously buy a bit more. Yes. Those two things may well come together.
Yeah.
So more clarity on the outlook, and that might make things cheaper. Not necessarily, but it may be the case. So it's not necessarily the absolute level; it's the absolute level and the outlook combined.
Okay, that makes sense. So taking that view that they're sort of underweight risk assets, and I presume risk assets, you mean equities, shares in companies?
Largely equities, but some of the real assets that we look at, things like that. Yeah.
So does that mean that being underweight those, does that mean you're overweight something else? Or?
Well, we're overweight. We've got more cash in our portfolios than we've had for a while. So the cash is up to 8 or 9%. The absolute return component of the portfolio is higher than it's ever been. And that's an area of the portfolio where we just look to return positive returns over any 12-month rolling period, whatever. So we're kind of sitting and waiting at the moment. I should stress that's not stopped us participating. We've had some good bounces. Most recently, the move up from the bottom has been the sharpest 50-day move we've seen historically. Wow. And I'm pleased to say the portfolio has participated nicely in that. We have taken some risk off the table since then. As I say, it just doesn't feel it doesn't feel now, particularly given the V-shaped recovery we've seen from markets, as the right time to be overweight these things with other people's money.
Yes. Yeah. That all makes sense. It makes sense. So just looking ahead then, if there's any clients that I've got, I can think of a few off the top of my head where you just sort of with the idea of investing money, it's not kind of essential that it goes in right now. We've got time to consider, but it could be invested now. Is there any kind of argument towards, invest now, why not? Or wait a few months and see. Just to give you a bit of context, it's long-term money, so we're looking. It won't be needed for 5 to 10 years minimum.
That's what it's all about. It's for you and them to decide what their time horizon is and their risk tolerance. But as long as they're not invested, even though inflation's low at the moment, they're effectively losing money in real terms because the cash isn't going to keep up with inflation. So on the long-term money, there's a very strong argument for investing for the longer term now. And, maybe you put that in bit by bit, you do a bit now, 25% now, 25% in a couple of months, I mean, just to be clear, we don't think, whilst we're cautious, we're not massively underweight, and we don't think there'll be any retesting of the lows or anything like that.
Yeah.
And so I do think if you want to return over and above inflation, then you have to invest. You have to invest at some point. And the opportunity cost at the moment is historically low because the cash is paying nothing.
Yeah.
So, I would say to bite the bullet and get in. The worst risk for an investment manager is when do I put money in the market? That's the hardest one.
Yeah.
History tells you that today is always the right day.
Yeah.
Historically, markets go up. Yes, there's dips and movements and without being facetious, today is nearly always the right day. But I wouldn't get overly carried away and maybe sort of drip feed some stuff in
Yeah.
But yeah, I certainly wouldn't be afraid of via a diversified portfolio, with the right time horizon within your risk parameters, to dip a toe in, definitely.
Yeah, why not? Yeah. See, my view on that is, my view has always been that's the way forward. In that, you can't time the entry. There's no point trying. Just get the money in and let it do it. It'll do its job over the long run, no problem. I think it's just because everything that's happened with such a sharp drop and recovery, and all the sort of unknownness going forward, that there's perhaps that hesitancy there. But when isn't there unknownness? We never know exactly what's going to happen, is it? It's no different to any other time in terms of investment markets.
I mean, if interest rates really are lower for longer, and if you just look at those FANGs, can they carry on? Is it rational? Well, the answer is it probably is, and it probably can carry on, because they're going to continue to make decent money, and some of the few industries that are. So I don't try and second guess. Don't try and time the markets.
Yeah.
Get your longer term investment money in.
Yeah, I see the same. Okay. Anything else that's happening that you might be useful for us to hear about?
There's no end. There's no end of things that sort of are going on at the moment. But it is a difficult time. I appreciate that for clients.
Yeah.
But I think I would just say, your last question is probably the most important one. Is it worth being in these markets at all?
Yeah.
Well, absolutely it is, because the risk for you otherwise is guaranteed loss of money, guaranteed loss of spending power, should we say? And that's to be avoided at all costs, particularly if the usual demographic for advisors is pre or at or just after retirement, and that's when the inflation is the real worry. And whilst inflation is clearly not an issue at the moment, you have to suspect that at some time in the future it's going to go up. It's going to go up because central banks want it to go up. They need it to go up. And I wouldn't fight that, and that would be a concern. And that is the real damage doer. I don't know if that's the right phrase or not. Damage doer to client portfolios, except client portfolios inflation.
Yeah, it is. Yeah, that's the biggest risk of all, in my opinion. I think that's, it's all well and good to look at an amount of money in pounds and pence, and in 5 years' time you might have the same amount of pounds and pence and feel like you haven't lost, but what you can do with it is so much less than before. So yeah, that is the killer. You're in demand today, John. I keep hearing you.
Oh yeah, my phones are going. Don't worry about that. No problem.
Is someone itching for a game of golf or something?
Can't be a fine thing.
Are you still playing?
I'm too busy. I've got no time for golf. We're too busy paying every bit of attention to your clients as we can.
Of course. All right, good stuff.
If I can sneak some in, I will.
Absolutely. All right, nice one. I think we'll end it there. Cheers.
All right, Steve. Good to talk to you. Catch you later.
Cheers.
Bye.